$1,280 billion. That is the staggering, unadulterated scale of the wealth erased from the gold and silver markets in a single 6-hour trading window today. Gold plummeted nearly 3%. Silver collapsed by over 5%. In that brief moment of market turbulence, $280 billion was stripped from silver's market capitalization alone. The markets are wide open, and someone is utilizing this specific window with extreme prejudice. I am John Egg. Here is the reality they refuse to tell you in the financial broadsheets. The very second you start questioning these official institutional narratives, you are immediately branded with a specific label. You are a conspiracy theorist. You are a doom monger. You are a radical skeptic. Whatever term they use, that label is not accidental. It is a meticulously engineered psychological barrier. Banks, media corporations, and globalist institutions spend billions of dollars annually ensuring that any alternative data point is equated with insanity in your mind. They do this because if you actually verified what they were doing with your money, your savings, and your purchasing power, the game would end tonight. They built a wall of ridicule to stop you from looking at the data. I am not asking you to climb it blind. I am asking you to check one source, just one. Pull up the Bureau of Labor Statistics data, read the fine print of a CFTC settlement, or analyze the latest Commitments of Traders report. That wall of ridicule evaporates the moment you stop listening and start looking. The ones who verify for themselves are the ones who end up in the comments, not asking basic questions they could find on a search engine, but adding complex data points that I haven't even had the chance to cover yet. That is the fundamental difference between a passive audience and an active community of researchers. If that is you, then you already know whether to subscribe to this channel. I am not going to ask for your engagement. The data should speak for itself. Let us look at the current divergence in the silver market. In the Western paper markets, spot silver is trading at $74, while futures sit at that same level. Meanwhile, the Shanghai spot price is $86, and futures are pushing $88. That $12 premium is holding firm, even as the Western paper price appears to be in a total collapse. Gold in the West is trading at $4,938, breaking decisively under the psychological $5,000 mark. Silver is now down a massive 40% from its January peak, which was above $121. The paper says crash. The physical says something completely different. That $12 gap between the East and the West is the physical market collectively refusing to accept the Western paper derivative pricing as reality. We are now only 8 trading days away from the critical first notice day on February 27th. March silver open interest currently sits at 58,770 contracts. That represents 294 million ounces of silver represented solely on paper. Here is what is truly strange. We see no mass roll of contracts and no panic unwind. The numbers are completely unmoved even with the clock running down hard. Either the roll hasn't started, it is being deliberately delayed by major players, or certain dominant institutions are entirely comfortable holding this size this close to the delivery deadline. When open interest stays this elevated this late in the calendar, it stops being a routine rollover and starts becoming a genuine systemic liquidity question. You can pull the CME open interest data yourself. It is updated daily, publicly posted, and completely free to verify for anyone with an internet connection. Furthermore, silver's 30-day implied volatility on the CME options market is currently more than 10 points higher than it was when silver was trading at its peak of $121 just 3 weeks ago. Read that one more time. The options market is pricing in more explosive potential at $74 than it did at the all-time high. This is not a single data point anomaly. This is a coordinated options market signal. What initially appeared unusual to analysts tracking this data has now been confirmed as real market pricing. The fuse is sitting right there in front of us. 3 critical dates now converge directly. February 20th is the SLV options expiry. February 24th is the Silver Futures American options expiry. That is the same day that the Shanghai exchange reopens after the Lunar New Year closure. Finally, February 27th is First Notice Day, when physical delivery begins against those 294 million ounces still open. That 3-day stack occurring within a 7-day period is not an accident of the calendar. Physical silver in Shanghai is trading at nearly $100 per ounce, which is a 20% premium above the paper derivative contract on that very same exchange in the same city. This isn't just East versus West, it is physical versus paper on one single exchange. The shortage is that severe. That data is publicly available for free through exchange reporting, and those who do their homework have already verified it independently. Now, zoom out for a moment to understand why this matters beyond a single trade. The United States national debt is officially projected to surge by $2.44 trillion per year over the next decade, according to fresh budget estimates. The total is reaching $64 trillion by 2036. That is double our current levels and triple the pre-pandemic levels. Annual interest costs alone are doubling to $2.1 trillion. That projection assumes zero recessions across the entire period. Meanwhile, every major global currency is simultaneously breaking down to new all-time lows priced in gold. Not just the dollar, all of them. The British pound, the euro, the yen, and the Swiss franc are all hitting new lows against gold. While mainstream media frames this as a metals story, it is actually a currency story. The dollar is simply the most visible casualty. Nassim Taleb wrote in The Black Swan about how systems that appear stable for long periods accumulate hidden fragility beneath the surface, then break catastrophically when that fragility finally expresses itself. The U.S. debt trajectory isn't a future problem. It is a present mathematical reality expressing itself through currency debasement right now, visible to anyone who checks primary source documents rather than accepting media narratives about strong economic fundamentals. Big tech credit default swaps outstanding jumped nearly 400% from $2.2 billion to $10 billion in just 13 months. A year ago, these CDS contracts on major tech names simply did not exist. Now, the AI debt binge that created leverage across the sector is being priced for default risk at scale. Bitcoin fell tracking equity weakness, with fear sentiment hitting extreme levels and ETFs seeing 4 consecutive weeks of outflows. Risk-off sentiment is hitting every asset class simultaneously. That is the environment where assets with zero counterparty risk become the final destination, even when they take initial hits in the liquidity flush that precedes the rotation. Here is the industrial reality that no amount of paper selling can permanently override. Silver is the most electrically conductive element on the periodic table. Civilization runs on electricity. Every solar panel, every electric vehicle battery system, every AI data center, and every piece of military electronics requires silver, with no viable substitute at scale. 1 physical ounce of silver currently costs less than a pair of sneakers. Think about that. That pricing disconnect between fundamental utility and paper market price is the direct result of decades of concentrated short selling. Mine CEOs are now reportedly fielding direct inquiries from major industrial buyers wanting to skip the exchange entirely. Arrangements potentially involving hundreds of thousands of ounces monthly at premiums reaching 20% or more above spot for guaranteed physical delivery are being discussed. Samsung has reportedly already executed exactly this type of direct arrangement. When manufacturers whose production lines literally depend on physical silver stop trusting the paper market to deliver, they don't petition for reform. They simply route around the system. That parallel physical market, as it grows, sets price based on actual scarcity. The paper price becomes increasingly irrelevant to real-world transactions. Iran fired missiles in the Strait of Hormuz today as part of a pre-planned naval drill deliberately timed while U.S.-Iran nuclear talks are active in Geneva. 20% of global oil flows through that single choke point daily. Even a pre-planned demonstration sends a calculated signal when diplomatic negotiations are simultaneously in progress. Energy supply disruption flows directly into manufacturing costs, supply chain stress, and industrial silver demand that already carries 6 consecutive years of structural deficit underneath it. Geopolitical pressure doesn't just move oil. It accelerates the institutional flight from paper promises toward physical assets when trust in the system is already eroding at multiple levels simultaneously. The bearish case deserves honest examination. 1.28 trillion wiped in 6 hours proves the paper market retains full power to override physical fundamentals in compressed timeframes regardless of shortage data. Silver down 40% from highs is real technical damage. Historical COMEX delivery averages near 5% of open interest suggest most of the 294 million ounces will roll or settle in cash, as it has in previous cycles. Iran drills historically produce initial fear, followed by rapid normalization when no actual supply disruption materializes. The implied volatility spike could resolve quietly if naked shorts successfully reload during the Shanghai closure window. Housing at the worst affordability since 2008 signals economic stress that forces broad asset liquidation, including metals, regardless of fundamentals. This is financial warfare education, not investment advice. But here is what the complete picture shows. Shanghai physical trading, 20% above paper on the same exchange, while the Western price collapses. 8 days left with open interest completely unmoved against historical patterns. Implied volatility 10 points higher at 74 than at 121. Options market pricing more explosive potential at the lows than the all-time peak. 3 critical dates stacking. February 20th through the 27th with zero buffer. Industrial buyers routing around COMEX at 20% premiums with Samsung already executing. Every major currency at new all-time lows against gold. 64 trillion in official debt projections. Geopolitical pressure on 20% of oil supply. These aren't separate stories. They are one story about a system under simultaneous stress. Watch the daily CME open interest. If it stays elevated into the final 3 days before February 27th, this stops being routine and becomes a genuine exchange stress test. Verify the data yourself. Logic over hype.